Satnam, welcome to the One Flow podcast. I'm Jai Gopal. I'm the host and creator of the One Flow podcast. And I'm very excited today because we're on with Jay Eichelberger. And I don't know if it's nepotism, if it's your uncle-in-law, but I think so. But because it's, I'm telling you, I'm very glad that I know this man. So, just a little background: Jay he had founded a wealth management company, and then subsequently sold that to another company, and I believe still works for that company.
Indeed.
But the bottom line is that he's very, very knowledgeable in the arena of wealth management and investing. And how I got to know Jay better, so I met Jay at our wedding because he's Jamila, my wife's uncle. And when my dad passed away in 2016, I was responsible for managing what he left behind for her, or their money, which wasn't an exorbitant amount, but it was, had to take care of her. And so I immediately thought of Jay, and I talked to Jay about it. And what proceeded to happen was mind-blowing because it changed my whole view on like what I didn't know about money and investing. And it was probably one of the best things that ever happened to me in my life because I learned so much. And welcome, Jay Eichelberger, to the show.
Thank you.
I'm so grateful to have you here. And to start, I would just love it. Well, first, let me say to everyone out there who, like, when money talk comes up, they go, and start to get rashes all over their body. This is, I told Jay ahead of time, just like when he started with me, this is, explain it to me like I'm 5. So this is for those people who want to get a start on investing or understand it better. That's what this is about. So welcome, Jay. And could you please give us a little bit of your background, your own story, how you started, where you're from, all of that.
Total pleasure. Thanks for inviting me on, Jago Paul, for sure. Everybody, finds a journey. Mine started a little over, 30 years ago. My wife was going back to school herself, and I decided to take a continuing education class at the local community college. To kind of fill up some of my spare time that I had, and was on financial planning. And I thought, well, what a neat subject matter. So I had never even thought about it as a career. I was working in retail at the time, right out of college. And but this gentleman that was teaching the class was something I'd never heard of before, a certified financial planner, a CFP. And over 30 years ago, that was really rare. CFP today is super mainstream. Anybody that's really worthy of giving advice has the CFP professional marks at the end of their name. But when I was getting started, hardly anybody has ever even heard of it. So it's kind of like the CPA coming out of the ground back in the day. Certified financial planner is really the credentials you want to have. So I went back to school myself, got totally intrigued, hit me like a lightning bolt. I knew that's what I wanted to do. That's what I wanted to be. And when my wife was going back to school to get her degree in medicine, I decided to go back to school and get my degree in financial advising, so to speak. So I feel blessed because I'd never heard of it. It became a passion, and I couldn't believe that a person can actually make a living doing this. I was so excited to partake. So that was my journey to get to where we are today.
So how long ago was that? When did you get started with that?
So, once I got my CFP, you have to do 3 years of professional work before you're allowed to hang out your shingle to do it. So I got involved with New York Life, and then Principal Financial Group, and some other, companies, so I could start learning the practical side of this. But everything back then was sales related. You couldn't talk to people were called brokers, or their insurance people trying to sell you things, and then that's fine. That was the only way business was done back then. But it just didn't feel good giving advice like that. And so I came up with this idea. Again, this was extremely rare, but I just thought, gosh, I just think people would be willing to pay a fee to get good, impartial, unbiased advice. Don't sell anything. Just give great advice, and they'll pass your name, on to others, and you don't have to market or advertise very much, and you just do the right thing. Um, but it really was unheard of back then. So we started off.
What was that time frame?
Probably 32-ish years ago.
ago? Wow. Yeah. So
And back then, if you put $100,000, into an investment, the person was getting $5,000 to $10,000 off the top by talking you into putting money in that investment. Whether you did well or not, they got that day one. And
that's how people were doing it. Wow.
That's how they were doing it. And so I came with this notion of, well, why not just charge a fee? And we started charging just 1%. And I would tell people, and it was true, we're going to use all non-loaded, non-commissionable. All your money's going to go to work for you. Nothing's coming off the top going to anybody. I get to stay on board if I do a really good job for you, and I'm going to charge 1%. So on the same $100,000, I was only making $1,000 per year to give this advice versus $5,000 or $10,000 that the salespeople were getting. But I knew one day if I did a really good job, we started with nothing, but by the time we got done and I merged the company in to Wealthspire, which is a fantastic company, I hope to talk a little bit about that if you allow me. But we were at 1.9 billion total assets under management
after 32 years or so.
After 32 years, started with that idea, and now fee only advising is mainstream. So when we started, CFP was never heard of, and fee only advising was really never heard of. But today, all the big brokerage institutions and such, they're all trying to catch us now and try to act and be the same way, even though not everybody really is truly the same way yet.
Wow, that's really interesting. So what I heard you say is that when you got into this, which was late 80s, early 90s, it was kind of I want to say an old boy system, but there was a barrier to entry. You had to have some decent money to get into, because $100,000 in late 80s, early 90s was a pretty decent chunk of money, I would say, compared to today and with inflation and everything. So you had to, whether or not they did well with your money or not, they were going to take 10% off the top.
5 to 10%.
5 to 10% up front. So then you came up with the idea of like, well, let's make it a little more, let's say, performance based. I'm not going to charge you up front, but I'm going to charge you 1%, of what I do.
You'd have to be with me 5 to 10 years to equal 1 day trade in that environment back then.
Wow, that's amazing. And well, so you invented something pretty good.
Well, it was a win-win for all of our clients and for our firm. And it just made sense. It's a feel-good thing when you meet somebody, you're doing the right thing, and they're much better off after they met you than before they met you. And you don't really have any dog in the fight, but just doing the right thing. And today it's called being a pure fiduciary, which is the highest moral and ethical legal relationship you could have with somebody.
So that's the first step of good advice for people on here, is that if somebody wants to charge you a big fee up front, you should be very scared about that, because that's pretty much not how things work these days. I wonder if there's any people out there doing that. Probably not, but
it's fewer and fewer. But there's a lot of insurance people masquerading as financial advisors. And there's a lot of wonderful insurance people, just so that we're clear. But there's a lot of people that they're playing games with the fact that they're fee-based and a fiduciary. And it's unfortunate. But if you are working with a certified financial planner, a CFP, you got a good person. And they got their own morals, ethics, and guidelines that we have to operate by. If they're not a CFP, then I would really start digging deep.
That's good advice. People are always saying on YouTube now, because it's everything's so widespread, this is not financial advice, but you can actually say this is financial advice, which is very exciting, because it gets so cliche now. Like like some YouTuber is like, this is not financial advice. I'm like, honey, nobody's looking at you. No, get over yourself. Nobody's first of all taking your shitty advice, and second of all, nobody's watching your channel, probably like the 5 subscribers you got. But anyway, it's good for people to have good self-image. So what I'd like to transition into is I'll tell a little bit about how our first meeting went. So back to my dad. My dad passed away, and then there was he had some investments over a lifetime, and so did my mom, and he was managing it all. So it fell to me to take care of that. And he had he was 83 when he passed away, so he knew that the time was coming. So he was very good about taking care of her and having her set up. So what he did was he went to Wells Fargo, which has a wealth management side of things, and he basically put everything under their umbrella to keep it easy for her when he passed away, because his son got into yoga, grew a beard, and wore a turban. He wasn't sure if I was up for the job or not. Underestimating me as always. As Jay will tell you later on, I made some good stock picks.
Yes, but indeed.
But so the way what transpired was, just as a matter of telling a story, is I went into Wells Fargo and I didn't know much, but I knew that these guys just weren't like sharp enough. I didn't trust their abilities. They were nice guys, and they were so nice, because when my dad passed away, it's always a hard thing for the family, and it was very hard for my mom. So these guys were super sweet, and it was hard for me to leave them. But I knew, that I wanted to talk to Jay because from New York, I got that old school kind of like, keep it in the family. Who can we trust with this? I don't want anything going wrong. So I called Jay and I said to Jay, I goes like, and he's so absolutely, we'll square you away and stuff like that. But what proceeded to blow my mind was that first meeting. And as a preview to kind of set it up, I had this meeting with Jay. I did not know what to expect. He goes, look, I'm going to send you a link and we're going to do a share screen. Now I'm going to tell you a little bit about strategy and investing. And I said, okay, great. Because I love Jay, and so I was looking forward to this conversation. Mostly I'm a misanthrope, and I which is weird for a yoga teacher, but mostly I'm like, get out of here. But with Jay, I was excited to talk to him, and then he blew my mind, and that's what I want him to talk about here in a second. So when we have this call, and then Jay, you came on, and you told me two things. You go, one, first you have to have a strategy. Like what's your strategy? Is it retirement? Are you young and you have a lot of years to make money and have more risk? And then number two, you told me about the market, and now that's what changed my whole world. Maybe I'm just not that smart, but it changed my whole world about how investing is not that hard if you boil it down. That's why I think you're so brilliant. It's like you figured out a few simple things, like explaining to me like I'm five. So please tell people, right, that first time when you told me. You showed me a chart of the stock market from 1920s to present, and you said that It always goes up. You just have to be prepared for the dips. And give me that pitch that you give them this pitch you gave me that first time.
Sure, indeed. And look, a lot of places you want to go, they want to razzle-dazzle you with all kinds of facts, figures, and how great they are, and whiz bang. But in the end, investing is not sexy. There's a very simple, basic truth. In that the stock market over a long period of time only goes one way, and that's up, period. If you think about it, since the beginning of time, the market's never not recovered from a downturn, right? The Dow just broke 40,000 the other day, all-time record. There's tons of dips between, the 20s to now. So the market's never not recovered. If the market doesn't recover, then we probably had an apocalyptic event. And I guess money doesn't really matter at that point
exactly.
in time, right?
Exactly.
So what we need to understand is that the average person, especially with today and media, you mentioned YouTube and TikTok and cable TV, bad news sells, and boy, they're gonna tell you when that market is getting blasted, or somebody can come on there and say it's about to get blasted. And they are absolutely right. At any given moment, that stock market will get blasted. And that's fine. It's like, really, who cares? The only person that cares is the person that had money in the stock market that they didn't have a long-term purpose for, a long-term game plan. If you have 5 years or more of time, the stock market gets safer and safer and safer. You have almost a 90-ish% probability of a very positive outcome in the stock market if you have a 5-year time horizon or longer. Anything shorter than 5 years, and you're day trading, you're just gambling. And that's fine. So lots of people like to go gamble. So you're going to gamble, go in and out in the short run, but for your real money, just know when the market pulls back, it's a buying opportunity. It's never a selling opportunity. And if you sell in a down market, You'll never know when to put that money back in, and that for way you will lock in your losses, and you'll never get that money back. So, once you understand that, it's not that hard. If you think about it, right? You always know when the market's up and you leave it alone. You'll know when the market's down. The whole world will tell you. And if it's down, you only got two things to do: sit tight, pay no attention to it, or if you got some extra cash, go buy things on sale.
So that's a very interesting thing. So the big takeaway here is that the long view, the market always goes up. 5 years or more, you're gonna win. And one of the problems that people get into is that they start day trading or trying to chase the market, right?
Or their buddies telling them, "Oh my gosh, I just got out of the market. Did you see that? I'm so lucky I got out." Market fell 5 or 10%, and they're like telling everybody how smart they were getting out. And then other people start to panic, and they all start going to the cliff at the same time. And but they never know. So that guy was so smart to get out, never knew when to get back in. When do you get back in? When the market's recovered. And so, you took that
Right.
10 or 15 or 20% hit, you panicked and got out, you get back in when the market's 20 or 30% back higher again. And so you lost that money. You're not going to get it back. And they've studied the average investor. The average investor totally falls behind the professional investors or clients who are professionally advised. And that's just as always shown.
Yeah, a few years ago, there was the big cryptocurrency crash because of FTX and
Oh, yeah.
a few other things like Celsius. And I got caught a little bit in that because I had taken out a little bit of a back loan with one of those companies. And so I was feeling the sting of that. And I talked to my teacher, who's a very wise man on all subjects. And he goes, "You know who has the best portfolios they found?" I said, "Who's that?" And he said, "Dead people." Because they're not trying to, time the market, right?
Right.
So,
That's true.
just real quick, and that's like super quick, because most people don't understand. I certainly didn't in the beginning. The difference between traders and investors.
Yeah. So, our traders are playing the roulette wheel. They're going in and out, constantly, some faster than others. Some people go in and out in hours. Some people might do it days, weeks, months. But they're picking a stock or they're picking something and they're watching it constantly. They think they know something that the wider world doesn't know. And that's a really painful lesson the average person is going to learn, that it doesn't work. But investors, everybody knows Warren Buffett. He is not a trader. He buys really quality stuff. He sits and he holds it. And then he makes long-term decisions. And when the market pulls back, he buys more. But he never sells in a down market. He only buys. So those are investors. The kind of stocks he buys, and I'll liken it to a seasoned firefighter. So let's say there's 5 row homes all attached, right? Sometimes the market goes on fire, right? The market catches fire, and a good smart investor will go in and they'll look at that as a firefighter. If this row homes or stock market, there's something on fire over here, whole stock market isn't on fire, just an area is on fire. And a seasoned firefighter says, wait a minute, they got fireproof walls and all these other places, they got sprinkler systems. I don't think it's going to burn to the ground. So the seasoned firefighter will go in there and say, well, I'll buy this row house, I'll buy that row house. I may not buy the one that's on fire, maybe even the one that's on fire, depending on how much they know about it. They'll get it super cheap. And those are investors. They're looking for these opportunities to buy something really quality, buy it at a good price, and hold on to it into the future when everybody else wants to come rushing back to buy it.
So investors have that long view, like you said, where they're looking 3, 5, 10, 20 years on the horizon. And then we know that from what you said, that the market always goes up. So it's about picking, good quality companies to invest in, or now digital currencies and digital companies to invest in that you think are going to go, for a while there.
Indeed.
And so one of the things I learned was that investors, like the average person is an investor. a trader is something you have to actually study and work at to become. And there are traders out there, and there are guys that make money. There's a guy on YouTube called Gareth Soloway. He's a bit of a bear, but you know, he tends to the very conservative side. But I learned a lot from watching his videos because he's like, look, the market doesn't lie. It's always in the charts. And so when he makes his trades, he's got a whole school that actually you can go to that where he
Sure.
teaches about that stuff. So if you want to be an in a trader, that's something you can do. Maybe you'll be good at it, but we're talking about, like, I would say 1% of the people maybe, could
If
become
that many. Yep.
traders, if that many, because it's a job. You have to do it every day, and first of all, you have to go to school. You have to or teach yourself, university, YouTube, or whatever, and
Yep.
then you have to go at it every day because it's not something you just go in like, oh, I'm going to pick some stocks and they're going to go up, and then in
Yep.
five, everybody's got that get rich quick thing. Get that out of your mind, I would say.
Oh, big time. And well, you make money by saving money, especially the younger you are. I can't emphasize this enough. Just compounding. Money doubles every 10 years at 7.2%, or it doubles every 7 years at 10%, 7.2 years to be exact, at 10%. So, the quicker you get money and get it earning, that money starts to double, and that money starts to double, and that money starts to double. Before you know it, you'll have real money. But if you wait till you're 50 or 60 and try to start saving money, you just don't have that much time for things to compound and work. So the quicker you can get going, the better. And look, you don't have to be, going to the University of YouTube or whatever and become a trader. The markets, the Charles Schwab's and Fidelities of the world, um, uh, some of these
Wealthspire
online,
Advisors.
yeah, well, Wealthspire Advisors, but
Your company.
these places have funds that you don't have to be smart. You just buy an index fund, so you can buy an index fund, the S&P 500 index fund. You get the exact performance of the index, and super cheap internal costs. Usually less than 0.2%, and having a Schwab account or a Fidelity account or whatever, Vanguard, T. Rowe Price, whatever, it costs you nothing. So, you don't have to be a smart investor. You just got to be a smart consumer and go into these index funds and let the money be. And if you're at a 401k, most of these 401k plans have automatic investing routes, target date funds. I'm going to retire in 2050. Okay, then pick a fund near that, and they'll do all of it for you. And they're very, very good. But your job is to save and put money in it and leave it alone.
So that's is that kind of like dollar cost averaging, where you're saying you want to invest and keep adding because every 10 years or at 7.2% return, you
Yep.
will double the money you put in.
That's
and
right.
then at every 7.2 years, if you're getting 10% return, which in today's markets can seem pretty possible,
Yep.
then your money will double in 7.2 years at 10%, right? So
Yep.
if you're a working person and you have a little bit of extra to invest, doesn't matter how small, you open one of these accounts, whether it be in the regular stock market or now cryptocurrency exchanges. And so if you want to buy Bitcoin, but like you said, index funds, there's a thing called an ETF, which we'll talk about later,
Yep.
which is basically an index fund for Bitcoin. So if you don't want to
That's
go
right.
through the crazy tech stuff, you can go and buy this through an investment company now, where you can own shares of Bitcoin in a fund.
Yes.
But what I wanted to touch on is that I have found, and I learned this not the hard way, but I learned it over time, the dollar cost averaging.
Yeah.
Just real quick, tell people what dollar cost averaging is, because that's kind of like what you said about compounding, and
Yep.
and as a great strategy to invest over a lifetime.
Yeah. So, most people are getting paychecks and they have 401k plans or retirement accounts. And you can have money automatically taken out of your paycheck to go into these retirement plans. So if it's weekly, bi-weekly, bi-monthly, monthly, money is going in on a constant, trickle. And so when the market's down, you're buying more shares of the same stuff at a cheaper price. And statistically speaking, the market is going down about 30% of the time and rising, recovering 70-ish% of the time. So with this dollar cost average, you're buying a lot of shares on average cheap, But if the market's down and you're cognizant of it, you have a choice to put the money in. It's hard to do. But if it's automatically coming out, you don't even think about it. You don't even miss it. And you get a nice little tax break, by putting it in the retirement plan to put it in there. So it really does kind of turbocharge your results by dollar cost averaging.
That's interesting because I never thought of that, but that's kind of how 401ks and stuff work. They dollar cost average because every month you're putting stuff in. But a person can do that on their own if they have a little extra.
They can indeed.
And it sounds like a great opportunity when you explain it. But I'll tell you what, for me, was even better is I went online and I found for Bitcoin, I found a dollar cost average calculator. And when I could see it with my own eyes, that was really cool. So like if you Google search Bitcoin dollar cost average calculator, these different calculators come up on different websites, and you can put in like, how much would I have made if I would have started investing in January 2017 to the end of 2020. Of course, there's these, we know the site.
Yeah, and even the S&P 500, I'm sure you could Google it for that too. So
yeah, I'm sure they have those calculators.
Right, yep.
Absolutely. So that's something you can do, is to go to take a look, because when I did that, I went, oh, wow, had I just set it and forget it, like $100 a month or $100 a week or whatever you got, if you do that, like Jay said, you'll buy up, you'll buy down, but every single time, DCA works better than if you're buying here and buying there.
Indeed.
I found. But what I want to go to next, Jay, is one of the things that you said that also impacted me so much back in our conversations so long ago now in 2016, right? It's almost 10 years. But one thing you said that I think was so helpful and put a picture in my mind was, not only does the market go up all the time, but there are these dips. And then you explained how a dip, now this is the stock market, things are going much faster now, but these dips last 3 to 5 years to, like a real crash will take like 3 to 5 years to recover. And so what you told me is all you need to do is be prepared for those. Can you tell people that, about how would you be prepared for that?
So I think more specifically, we were talking about especially retirees, and at this particular time, mom was retiree and she had certain expenses. So we always want to know what I call it our burn or spend rate is. So let's just say it was, $5,000 a month and $60,000 a year. The way that one of the ways we protect our retirees is making sure you have 5 years of spending power, super safe, maybe in ladder CDs. So as an example, in that story, we were just saying 60,000. So you buy a $60,000 1-year CD, a $60,000 2-year CD, so on and so forth. So you have 5 years. So every year a CD is maturing. So no matter what the stock market's doing, up or down, if it's down, you don't care about it because you got another CD right behind it. If it's up, we cash in a little bit of winnings and we replenish our CD wheel. So knowing that you have that safe money, you do not have to do knee-jerk reactions when the stock market starts to fall. And because when you make that knee-jerk reaction, you just locked in your loss. You'll never get it back. And so, a lot of early investors, younger investors will panic because they have too much money in it. They don't have that safe money. So if you're really young, make sure you got 6 months of emergency reserves, in your savings account somewhere. That gives you staying power. So you're not worrying about your 401k or going up or down and all around. So in your case with mom, we made sure we had 5 years of super safe money. And we had some bumps in the road that 2018 was not pretty. Last 3 months of 2018 was not a pretty time in the stock market. But did we have to worry about it? Nope. We had plenty of safe money.
Yeah, I remember that bull in my mind. I was like, it makes so much sense. And then on top of it, now you just reminded me, I had forgotten about this, but the idea of then keeping, so like 60,000 a year, you have 5,000. So if you, luckily for retirees, you hopefully have that much. You got $300,000 that you set aside, and then you put it in these interest-bearing things that are maturing 1 year, 2 year, 3 year, 4 year, 5 years. So each year you're getting 60,000. And if you're up and you don't need to use it, then you can go and put it back into the market. So there's all these like amazing strategies, which if somebody's interested, they can contact you. Do you want to talk for a minute about, and then after that, I want to talk about well, let's stay on this for now.
Sure.
Just while we're still on this, and I want to talk to you about Wealthspire after this, but since we're on that idea of reinvesting, one of the things that got me that I learned the hard way was taking profit. Now, I know that's probably a different strategy. That's probably for maybe younger people, but it could be for retirees also.
Totally. Sure. Absolutely.
What I missed, and I'll tell you what, this was a psychological sort of emotional thing, which was that when things are going well, you get this idea that it's going to keep going up, and there's these fevers in the market. Like there's like this excitement and fear of missing out, FOMO, on the way up. And then there's FUD, fear, uncertainty, and doubt when things are going down. And like you said before, that's what causes people to sell and buy irrationally. And so people end up buying high at the top and then selling when it's crashing, and then they screw themselves all up. But let's say you're doing well. What's the strategy for like taking profit? Let's say, you could use any hypothetical example you want. And I didn't even know what taking profit was. And a friend of mine said, at this point I started taking profit, and I was like, what does that even mean? So tell us about taking profit and what that concept is.
And, this is it's almost like, asking what kind of drug would be best for, a sore leg. I mean, there's so many things it could mean, depending on what age you are. And is this an individual stock, or is this, because we have our income wheel and the market's up, should we take profit? So let's just use two examples. Okay. So a lot of times people will come to us, they inherited their parents' portfolio, and they have, a whole bunch of money in AT&T stock, let's just say. So you look at them and say, well, you have $500,000 of AT&T stock. Your net worth is $1 million, so you got 50% of your money in one place. If this was cash sitting on the table right now, $500,000 of cash, would you rush down and buy AT&T stock? And almost always this, well, hell no, I wouldn't buy that stock. Well, I'm like, well, why are you holding it then? If you wouldn't buy it, why are you holding it? You got to take profit. Or let's just say, you're looking at maybe it's your Bitcoin. I put $1,000 in it, and now it's up to $100,000. You got to ask yourself the same question. If I had $100,000 of cash, would I put it all in Bitcoin? If the answer is yes, then leave it alone. But if the answer is no, then there's a number that's probably right. So we always think it will always continue to go up. But if certain things are super diversified already, like the S&P 500 fund, and it's up, we don't worry about that because it can fluctuate, go up and down. But look, it wasn't long ago when General Motors was considered, the premier stock. How could it ever go bankrupt? But that's exactly what happened to it. It went bankrupt in the big market crash that we all know about, 2008. And those shareholders all got wiped out. We all know about Enron. So there's a whole bunch of people owning Enron. So for the individual stock, you need to have a point where I'm comfortable. Maybe I put $2,000, that was worth $5,000. Maybe I take my $2,000 out that I originally put in it. So I'm only playing with the winnings now. Start to diversify it. But it's hard because you get to be emotional because you think it's going to keep going up. But it's smart to have a strategy before you buy it when you're going to get out.
That's interesting. So you should think about these things about where and discuss it with your advisor or whatever. Like I'm getting into this stock. Like one of the picks I gave you was Amazon because I just just an aside, this could be helpful to people. Is that when I was in the Army, there was a fellow officer who had an investment club he used to go to, and he said, I said, what do you guys talk about at this thing? He goes, oh, we all get together and we discuss about, like, first of all, what we're using in the marketplace, like what companies are we buying? And then we all share that, and we talk about why we like those products, and then we buy those stocks. And I was like, again, it's not as simple. Like I think that people in the news and all that, they like to make you think that money, investing, and all this stuff is really, really hard.
Totally.
To keep you confused because they don't want the average guy being super successful. Maybe that's too conspiracy oriented, but I think if you're at the top and you're running things, you don't want any competition. So I mean, it just seems like they confuse things a lot, right? So
Yeah.
it's really not that hard. So picking
Ah.
stocks, this guy was like, pick what you got. So when you came to me and you said just that very thing, your dad had bought all these kind of old stocks. I don't think they are long for the world. I'd like to rebalance some of this stuff.
Yep.
And then I said, I went and I used that theory and I picked like 5 or 6 different stocks, and they were all things that Jamil and I used in our business or in our daily life. And those things ended up going really crazy because the markets went up nuts and stuff like that. But one of the things that caught me, which is why I asked that question, was with the Bitcoin. I obviously was very heavy on Bitcoin, as these people know, and cryptocurrencies and stuff. When I found out what the technology was, I was like, this is going to change the world, and it's proving to do that. Was that I started taking some of those profits from the old stock stuff and then put it into Bitcoin and so on. But then Bitcoin went nuts because it's a computer program and it's actually programmed in and it's to be scarce, and so the price goes up very quickly in certain parts of the cycle. But I was just like, I needed to go up more, and I didn't take anything out. So good to have a strategy to take some out and then diversify it. And you have to decide, like, okay, I put in 1,000. This is now 5,000. Am I going to take out 10, 20, 30%? I actually heard, maybe you can verify this one way or the other. I heard someone say on one of these podcasts that these investment funds like ARK Invest and some of these others, they have a kind of a policy. Once things go up a certain amount, they take out 30%. Is that a kind of a industry standard thing? Do you know?
I don't know this. It might be more fund specific, their particular strategy, but all these firms have a plan for what they think the stock is at today and where they think it's going to go. And once it starts getting near that level, they start paring back on taking some of the winnings and redeploying it into other opportunities. And that's, every investor, if you're going to go that level of picking stocks or picking Bitcoin or whatever it is you want to pick, you need to have a plan for what point, what's the old saying, pigs get fat, hogs get slaughtered, right? So, get fat, but don't stick around at the party maybe too long on specific holdings. The market as a whole, fine, right? Fine. But, Bitcoin, accelerated up, had a dramatic pullback. A lot of people panicked. A lot of people got lost. And what are they doing? Bitcoin went back up, so they're starting to buy it again. So, pick what is long term that you can grow old with. And if you want to gamble with really small amounts of money and have fun with it. But for real investing, you want to buy stuff you believe in. You're going to hold it for a long term. And then that gets hard to take the profit. But as long as you have plenty of safe money, you don't worry about pullbacks. Make sure you got at least, an emergency fund. And if you're a retiree, make sure you got 5 years worth of super safe money. And then go along with the rest of it.
That's a good point. It's okay to gamble. If you have a little extra scratch, you can pick some stuff and play with it, like play some day trading. But I really like I guess the theme of this is the long game, because and that's also, the title of this podcast is The One Flow. There's one creative flow coming through everything, and we know from nature that it's always expanding. The universe is always expanding, and that's what I love about, and I think that's probably why it blew my mind so much when you came to me with that. You're like, hey, the stock market always goes up. Everything always goes up. Everything's always expanding, but you just need to be prepared for the balance, the duality that comes in, and that's so. If you want to win, it's a long game. You can play around, but it's a long game. I do want to talk more about Bitcoin, but I want to change gears right now and talk about you and your company more, because I know you were very successful in your previous company, and then so successful that another company wanted to buy you, and you recently sold to that company, which is Wealthspire Advisors. You want to tell us about your company before, and you grew it to, you said $1.9 billion in assets, and you sold to Wealthspire. So go over that story a little bit and tell us where you're at right now.
So, our journey, like I mentioned, I got blessed with coming out of the ground 30 years ago with who's my best friend today, a partner by the name of Jimmy Greaser. He and I both shared the same kind of idea, but boy, wouldn't people just love to pay for good advice? And they can't get it anywhere. Everybody's got a dog in the fight. And how about if we just launched a company that doesn't have a dog in the fight, just charge a fee for the work that we're doing, be a fiduciary, do the right thing. And boy, it just started to grow. And we got some wonderful new employees, and we got some other new, partners I got blessed with. And I guess, like you said, the flow, everything's expanding. I think if you're doing the right thing all the time, good things will happen and things will continue to expand. So before we knew it, we had three locations, Eastern Shore of Maryland, Columbia, Maryland, and Annapolis, Maryland. But it was all on this premise of doing the right thing, serving others to make lives better. And it's just what got us up in the morning. And so, things were getting, I'm turning 65 in July, getting up there in age. The younger generation was very excited about what we're doing. But we were getting so big that I was going to have to start really looking at building some more infrastructure, getting the, state attorneys on board, maybe building a trust company, a lot more investment was going to have to happen. I said to our management team, why don't we just take a pause and let's just see if there's anybody else out there that does it just like us that we can really feel good about. And we called it Project Unicorn. And believe me, we went out there because, we all know they're pretty, but they don't exist, right? Yeah. So we called it Project Unicorn, and we kissed a lot of frogs in our multi-year process of looking for a suitor. And as fate would have it, we ran into this firm called Wealthspire, who they were kind of coming out of the ground themselves, but really were already ahead of the game. Already had a trust company, trust services, already had estate planning, already had everything that we were doing, but even just better. But more importantly, the morals, ethics, and values of the company. It was just such a match. And it was so wild because we first met in March of 2020, and that was the day. On that day, Governor Hogan in the state of Maryland was closing down the state of Maryland for the pandemic. But the CEO, Mike LaMena, and others still wanted to come. They flew down. We drove up, and it's just one of those magical moments, man. We all just knew this was going to work. And so here we are today in 2023. Our entire team and all of our clients all are completely happy. And we're doing great things then. We're doing greater things now.
So it was like a merger. It was like a merger then?
Yep. They acquired us 100%. Mm-hmm. And so I'm no longer a shareholder, but I am a managing director with the company. And I take care of clients, just like all my partners take care of the clients. And but it's wonderful because they have the investment in the technology and all the compliance and everything that we need on steroids. For the benefit of us and the benefit of our clients.
So if people want to get in touch with the Wealthspire Advisors, we'll put that information in the show notes and so on. So
you just Google it. You'll find us easy.
Wealthspire. S-P-I-R.
Yes, S-P-I-R-E. Yep. Advisors.
Excellent. Awesome. And so you're still an advisor at that company.
I am.
And how many people work for the company? About?
Oh boy, I'm probably the 300s.
Wow.
Yep.
So it's a pretty decent sized investment company.
Yes, we were the first. I think one of the first firms that they acquired. Mm-hmm. But since then, they're very selective. I can tell you that of who gets in, which I'm happy about. Yeah. And they've got a great new firm in California that they've acquired, and we got New York, we got Midwest, we got Florida, we got Virginia. So it's growing, but on these core premises of doing the right thing for people, fee only, true fiduciary, and these people are young and passionate about serving others.
That's what I absolutely love about it. And I want to call attention to that because that's, first of all, you blew my mind with the principles, and I knew I could trust you. But what I love about your story is that you you could have sold out to anybody.
Oh, sure.
Your company was worth $1.9 billion.
It wasn't worth 1.9 billion, just to be clear.
Got you. Okay, I'm sorry.
Those are the assets under management.
To me, it was assets under management of 1.9 billion,
but
which is not a small thing.
No, no.
So,
the average firm has 300 or 400 million. The average firm has 300 or 400 million. So we grew ours to 1.9 billion because I think we were doing something right.
So you had done very well by the people that you were working with, but this is what's refreshing is that you felt, like you said, a fiduciary responsibility to these people to take care of them, and you didn't just pull the parachute and jump at the biggest offer or anything like that. You went looked for the right person.
Everybody at Wealthspire has a passion to serve, and that's why I could not only because we had sold to anybody, but I could have sold and left. But I love it. I got this passion. We all share doing the right thing. It's like psychic income, right? That it's a really feel good thing to work with people and help. Everybody there is wrapped up like that.
And I can say that from experience. Everybody that I interfaced with when I was working with that account for my mom's money was super nice, but I couldn't really gauge it because, Jay's my uncle-in-law, and like I said, nepotism. So I thought they might have just been being nice because I knew the main guy, but I can kind of tell from what you're saying that that's the truth. They're all like. It's the attitude that is important,
It is. It's the mission. It's the passion. Just like you have a passion for what you're doing in your podcast. Everybody there is like, I don't know what else I would do because this is what I do. This is what gets me up in the morning. Why would I stop doing it?
Yeah.
So,
so let's move on to Bitcoin really quick because that's where we got. We got into like big conversations about that, and I was like all hot on that when we first started. And so these guys know all about Bitcoin because I did a couple of episodes about that. But what I'd like to discuss with you is this new Bitcoin ETF. And so what I'd like you to talk a little bit about, first of all, what is an ETF, and then what is the significance of the Bitcoin ETF?
Yeah. So ETF is an exchange traded fund. So it's a vehicle. Mutual funds, as an example, hold lots of different things inside of it. It can hold one thing or it can hold lots of different things. But the difference is the value of the mutual fund that your money gets credited is at the end of the business day. You can't trade a mutual fund intraday. You can only sell it at the end of the day. You put the sell order in whenever you want. It won't execute till the end of the business day. An ETF is almost like a stock in that you can trade it every minute of the day. You don't have to wait till the end of the day for the transactions. So the ETF is traded constantly. It's being priced every minute, every second of the day. In this case, now we have an ETF that's a spot price of Bitcoin. So, it's backed up by Bitcoin. It's valued every minute of every day to the Bitcoin. The only difference is that they'll have a very minor management fee inside to do that because it's not easy for them. So they're going to get a little fee. And, if you buy Bitcoin yourself, there's really not much of a fee because you just kind of do it yourself. But inside the ETF, there'll be a very, very minor fee, almost inconsequential to trying to hold it yourself. But the big thing is that now in the ETF, prior to this, the average person, had to be somebody like you, Jai Gopal. I never got my own wallet or anything else. I'm like, I'm too old, I'm too complicated, I don't feel like doing it. So there was really no easy way to buy it. But now, you go to any brokerage house and buy a Bitcoin ETF. Charles Schwab, Fidelity, they're all over the place. You can buy these now. And soon they're going to start showing up in retirement plans, 401ks, as an investment option, a prudent, potentially, investment option. So it's really out there in the world now for everybody. If they want to buy Bitcoin, they can easily buy it. It's not hard. It's very straightforward. Any brokerage account can hold it now.
So that's pretty significant because that means Bitcoin is going to really go up quite a bit because or it tends to go. What's your opinion on that? You think,
Uh,
if I may ask,
yeah. Well, it would certainly seem that way, right? I can't, you know, can't I and now I'm going to do my disclosure. Can't say that Bitcoin's a great investment because uh, it's I don't know the people on the other side of the screen and everything else, but I can tell you the world thinks it is, and uh, and it's available, and the regulators seem to think it is. The SEC approved the ETF. So if you want some Bitcoin, it's very easy to get. You don't have to be a technology whiz to buy it and own it yourself. Um,
So can
that's
somebody
helpful.
go on right now, like you said, if you have a Schwab account or what is it,
Yep.
E-Trade account, and
Yep.
you can go on and buy the Bitcoin ETF now.
Yeah.
And there's like 12 different ones. The different companies offer them, different management companies offer. So there's BlackRock
BlackRock,
and
right?
12 shares and all that, 21
Yep.
shares and all that. There's about a dozen of them, and you can buy whichever one you want.
Yep.
And that's like owning Bitcoin without having to touch it, which Maxie's like me. I want to have it in my wallet because I don't trust anybody. But
Just don't forget that combination.
yeah, right. Yeah, I got backups, but
Okay.
and luckily I don't have that much. So if I lost, it wouldn't be that big a deal. But the so the ETF is kind of a good thing for people, and like from what you said is that it's relatively new since January, so it eventually like retirement funds and more people are going to be using it because like you said, many people seem to think it's a good investment at this point. So based on that logic, we can maybe assimilate that there's a good potentiality for it to go pretty strongly.
I wouldn't be shocked.
Put those
I wouldn't
put
be
it in
shocked.
those terms. So just what we got a couple minutes left, but I'd like to touch on a couple of things I think would be beneficial for the audience. Is first of all, you know, in the last 4 to 5 years, we've seen things get a little tougher. I mean, I know the markets and stuff have been going up. So for people who are savvy and invest and have been investing, maybe it's not stinging as hard, but not for nothing, but we're sitting here yesterday. We live in a good neighborhood in Los Angeles. We live adjacent to Beverly Hills. All of a sudden, there's, well, what they call the ghetto bird is up. The police helicopter's above us. And I knew something was up because it's never usually that close. And this helicopter's coming, and then all of a sudden I never heard them talk. Like, so they start talking from the helicopter, and I
Wow.
can't hear what it says. Now Jamila has gone out back with our friend Shabanatma because she wanted to take pictures of her new scarves for her website and stuff like that. And I had headphones on watching TV, and I actually took them off, got up because the helicopter's talking, and it turns out Jamila and her friend were out in the back, and the helicopter was saying, "Put down your weapons." And again, Beverly Hills adjacent, put down your weapons. And Jamila gets on because you got an app for everything now. And she said there was a bank robbery at the bank up the block from us. And so maybe that's a little bit too much of an intro, maybe too dramatic, but a lot of people are feeling the sting of inflation. So, I mean,
That's
can you
right.
talk about, I mean, maybe this isn't a short, but however you want to approach this, what is going on in the world today that prices have kind of quadrupled, and you got like an energy bar you used to buy that was like 8 ounces is now like 2 ounces, but it's in the same size package. All these games that are going on, inflation, and all that pressure. Tell people what that's about and where you
Sure.
may think it's going.
Well, and there's a lot of people smarter than me can opine in detail about their thoughts, how it got really ramped up. But to me, and I think hopefully to your listeners, a simple way to see this is, when the pandemic happened, and shipments weren't coming across the ocean, and things weren't getting made because the factories are shut down. I mean, inflation is caused by too much money chasing too few things, right? And so, prices start going up because there's a scarcity. I mean, even toilet paper, right? At one point, everybody was hoarding toilet paper because they couldn't get enough of it. And so that really started triggering that. At the same time, the government was, I call it airdropping lots of money on the people. And it's not a right, wrong, or indifferent thing. It's just what happened. And that gave even more people too much money, chasing too few things. And so inflation really started to ramp up, and people they were spending money, and a lot of them are racking up credit cards and everything else. So, we also turned off the oil spigots. Again, I'm not being political. It's just a fact. And oil prices started going up. So you think about everything that hits the average consumer. Gas, food. Since 2020, it's up over 38%. So they might say inflation is coming down right now, which it is, thank the Lord. It is coming down, but a 3% inflation on top of 30-some% still hurts. So we haven't caught up. The average person hasn't caught up to that 30% hit. So it's growing at a slower rate, but those higher prices are here, and their incomes haven't caught up to it yet. And so the average person is now working 2 jobs. They're doing a lot just to get food on the table, and there's a lot of desperate people.
So increasing the money supply quite a bit, it makes kind of basically dilutes the buying power. Then airdropping, like you said, airdropping a bunch of more currency, which they just printed.
Yep, they just printed.
And so you got all this extra paper basically trying to buy these goods
More
and
things.
it gets more things. And it gets and so it's kind of a devaluation in a sense, like you get less buying power.
Yeah,
It's
totally.
really like they call it inflation, but it's really less buying power. Right? You can't get as much as you used to get with the
same
money,
dollar.
The same
Right.
dollar, right? So just to wrap it up, I would say, like, what would you say to somebody who wants to get started that may not have that much money? Because a lot of people think like they don't have enough to get started.
Yeah.
Before I go on to that, though, I'd like to say this. We were realistically positive here, but I think we're in a time where it's certainly a transition. We have new digital currencies coming out. The world is definitely changing. AI, we got a lot of stuff changing.
You bet.
I just want people to remember that, while things may be pressurized and tough, there's always an equal and opposite opportunity there. There has to be by the laws of duality. So if one thing is happening and it's pressurized and negative, if you look hard enough, there has to be an opportunity to balance that out somewhere. So if you are having a tough time in the world, train your mind to look for the other balance in there. It exists, and maybe we could touch on that. But and so that leads me to this: what would you tell somebody, like you said, who maybe working 2 jobs or is really hustling, and they want to get started to flip the script and get into a place where they can build some wealth? What would you tell somebody? How can they start, even with just a little bit?
So when my daughter first got her very first job, it might sound like a commercial for Charles Schwab, but Charles Schwab, Fidelity, all these places have these things. You can go right online. You don't need to go to an office. You can open up an account, and they have these, I call them, robotic systems, where you say, hey, I'm gonna put $100 a month in. It'll do. You fill out a little risk questionnaire, and they'll have these great algorithms that will invest your money in well-diversified funds and well-diversified portfolios automatically for you. And I can tell you, she woke up, 12 months later, 24 months later, and she's got a heck of a little stash. My daughter does. Now, the other component to that, though, is it's not how much you make. It's not how much money you make. It's how much money you save. So, if you can't work more than 2 jobs, or right now you just can't get that pay raise, you got to look for ways to spend less, whatever that means. Because, The millionaire next door started with just about nothing, but they never lived over their limits. And so there's lots of people that I have met in life that live in a tiny little row home, and they are loaded because they lived well below their means. So find a way to save, and getting started is just not that hard. Go right to the website, go to Charles Schwab, go to Fidelity, go to Vanguard, go to any of these places, and open an account and set up automatic savings. So it's coming out of your checking account no matter what happens. Do it automatic, and one day you'll wake up with money.
That's great advice, and I want to add to that because it's definitely, the whole thing around money is very psychological, and because of the pressure of inflation and stuff like that, it does a job on people's brains. I think it certainly did on mine, and it's a feeling that you can't afford to invest, but in some ways may sound cliche, but you can't afford not to, because they're printing the money, it's buying less. You have to find some way to make that money grow. So you got to put it in something that's going to hold and expand in value. But what my point is that, to add to what Jay said, is that I've found, once I learned about this, I would think there was stuff that I couldn't afford to do, and then when I did it and it was just $100, I didn't miss it, because right. They call it set it and forget it, but it's like you don't think you have it, but then when you do it, it's almost like something fills the gap, and
it's called the pay yourself first principle.
That's
pay
good.
yourself
Talk about
first,
that.
right? Pay yourself first, and spend whatever you got left over. But the very first person that should get paid when you get your paycheck should be your savings account. Build up 6 months reserves, and after you build up 6 months reserves, look up a Schwab, Fidelity, Vanguard, or one of these places, and get a brokerage account, and then start saving there. Pay yourself first, and you spend what's left. It's amazing what will happen.
I like that.
Find a way to save.
That's going to be the title of this episode: Pay Yourself First. That is a great concept, and since we're this, we lean towards the spiritual here in the One Flow. Just remember, money is energy. You go somewhere and you expend your physical energy. You have a soul, and that soul is infinite. And you go to work, and in the physical body, you get tired and you don't have infinite energy, but you got infinite reserve to expand. Right? And the markets expand. So expand yourself, expand with the markets, pay yourself first.
Pay yourself first.
But remember that money is energy. So you can, if you intend it and you want to get there, you can expand and you can prosper for certain.
Indeed. So, and just one more comment.
Yes, sir.
The harder we are on ourselves today, the easier we can be on ourselves tomorrow. So, work hard. Pay yourself first, build up a reserve. Before you know it, later in life, you're going to be able to have a really nice life.
That's excellent.
Right?
Have the discipline to pay yourself first. I like that.
Yep.
Well, Jay, thank you so much. I'm very glad and grateful that we're family, but even without that connection, you're a very smart man, and I feel very blessed to have your advice in my life, and I feel even more grateful to be able to share that with the world. And so I thank you. I know you're a busy man, and you didn't have to do this. I'm very grateful for you taking the time to share your wealth, which is really your wisdom, with everyone.
Maybe it's a passion. I just can't believe I get to do it. So I feel very, very blessed, and thanks for having me on your show.
Sure. And Jay's with Wealthspire Advisors, and all that information will be available in the links below. Thank you, Jay. I appreciate it.
Best. Take care.